Greetings, Dr. Jeffrey Scott, and this is my weekend market update. Doing this from the American Society of Hematology meeting in New Orleans. And if the audio is bad, it's because I'm not at home on my system. I entitled this week's episode Hot Inflation, Cold Markets with Fed on Deck. Again, my email address for any questions or comments, hgsidoc@gmail.com, and you can always put comments underneath the video on YouTube. Disclaimer, this is for educational purposes only. Any recommendations are in the spirit of education, not investment advice. I'm a doctor, not a broker. I am independent. I paid for the tools that I use, and trading involves risk. You are solely responsible for any investment decisions you make. I trade mostly options. These are considered risky, and you should always consult your investment advisors and trusted sources like the Options Industry Council before trading them. Sorry that there was no video last week. I had one of the 2 live meetings I do a year. This one was down here in South Florida. We had awesome weather and a great time, and thanks to those that attended. I think hopefully you guys found value. Certainly tired me out. Speaking of live events, I'll be speaking probably twice at the Wealth 365 event coming in January. I'll put this link underneath the video on YouTube, but if you were able to join, I'd really appreciate it. During that summit, you'll have the opportunity to buy wealth charts at the lowest price typically of the year, and you'll have a number of speakers, including myself, offering you some cool tools at the seminar or summit price. So I always like to remind myself of this slide because it really matters where we are. You know, the month of November was a rip-roaring rally, and it really felt to some that we're done with this bear market. The Dow actually entered bull territory, being up above 20%, but then we got a PPI this week, and the market sold off, and it was one of the most painful weeks the last week that I can remember, especially for growth stocks. And it's important to remember that high growth stocks will go up like a rocket, but they fall like rocks. And we saw that this week. Where are we in the cycle? And sometimes you have to look at weekly charts to say, you know, it almost feels that I would invert this chart and that we were down. We got to sort of a uncertainty phase and then started to go up, big bull trap, and then we just dropped again, and it feels like we're going lower. But as you'll see in this coming video, there's a lot of things that could happen this week that are likely to move the market a lot. Now, when I figure out where we are in the market, it really helps me understand how I should be playing the market. And you need to know where that equity, that industry group, that index is, because you need to play it differently for different stages of the market cycle. Now, this is an old Ian slide, and I used it this weekend. And, you know, I grew up in Detroit. We used to play chutes and ladders. But in England, where Ian grew up, they played snakes and ladders. And, you know, this is a time to remind yourself, do not play snakes and ladders with your retirement. I think we got a big leg down coming here. We may be in the beginning. Maybe we rally. We'll talk more about that. But you don't want to be, you know, getting really close to retirement with your money. And you move from that 86 square to the 87 square. And the next thing you know, you're back to where you were when you were 24. And that's not how to build your nest egg. Cash is king. Cash is safe. And I would be very careful with this market. Major markets tell the story, and we could see that the NASDAQ and the Qs, the NASDAQ 100, are now down 30% on the year. And you could see the Dow is now down 9.2, the NYSE 12.3, and then you could see in the middle, 18 to 21, the spiders and the Russell 2000. We are still way off the October lows, but stay tuned, that may change. So markets are weak. The dollar's leading, and it's still down about 8% on the year as it's come off its recent highs. Now, rates have certainly eased. You can see here on the left the 10-year, on the right the 30-year have come down. And, you notice for the first period of the raise went up, the spiders followed. But you get to a point where rates continue to go up and the markets start to break down. Part of it was the rapidity of the raises. And I think now the rates are coming down is a bad thing, because why would the rates be coming down with the Fed still tightening unless there's economic and growth concerns? And I think that weighed on the market this week. Breath eases off, short-term overbought. Stocks above the 200, stocks above the 40, both got to areas where you might expect the market to reverse. And when you look at stocks on the 13-week new high, new low, I talked about at my live meeting last week that we were at a level we reversed, and we reversed. It's a great signal to understand short-term movement. If you look at the buckets, take the stocks in the S&P 1500, on the week ending 12/9, 69% of stocks are below the Bollinger Band midline. That tells you you're in a weak market. Notice a week ago, 80% were above the midline. So that's a pretty dramatic change. And in fact, we went from almost no stocks at the bottom to between the last decile and then those below the Bollinger Bands, 22% of the stocks in the market. Now, we don't expect to see a Hindenburg for a long time, because one of the things that you usually see it at are at new highs. But look at these internals. 3 of the signals are firing. We have lots of new lows, very few new highs, whether I look at the NASDAQ or the NYSE. And this is just not a healthy market, despite the November run. If we look over on the left from EdgeRater, we have a great tool called the Warehouse Report, where I load all the stocks in the market and I look at various variables. ERG, which is EPS rank plus relative strength plus group rank. And then individually here, first thing you can see is almost the entire market was negative on the week. And if you look at higher earnings and higher relative strength, they were not rewarded. So this was not a week for growth. And when you look at Friday right here, all the sectors were down, 85% of the industry groups and 78% of the stocks. So I think it's safe to say it was a very ugly day on Friday. And if you look at the 5 days in the market, 100% of the sectors down, 99% of the industries, and 88% of the stocks. It was not a good week for stocks. And this week we got more fun coming, I'm afraid. Now, we're also getting to that point of the year where people are going to wonder about seasonality and Netflix. Now, it was one of the presentations that I did at the meeting. And frankly, it's been one of the things that I've talked about for the last 10 years, because up until last year, not only was it a fairly safe trade, it was a way to make a really great return to start the year. So looking in wealth charts, and one of the things I like about wealth charts is you have a built-in seasonality tool that's just phenomenal. So I'm looking at the NASDAQ 100 here, and I'm looking out 8 weeks, and I want at least 10 years of seasonality. And what comes right up to the top here is Netflix. Now I know Netflix earnings are, I can tell you exactly, let me look at my calendar, but they're the week of Martin Luther King Day in January. So I think Netflix earnings are like the 20th or the 21st. Now, what I've done here is I've run this from the 13th, which is Monday or Tuesday, to the expiration after the, not the week of the 23rd, but the week of the 30th. And when you look at that, Netflix has been up 8 out of 10 years for an average return of 12.98. The 2 losses were big losses, especially in 22. When you look at the predicted performance of the seasonality of Netflix, it is extremely strong. So it'll be very interesting to see, we'll be watching it as we go forward, of whether or not the markets will reward the Netflix seasonality trade in 2023. Know your earnings. Here are a modest week of earnings. The key, it's a judgment call to hold stocks over earnings dates, but it's bad judgment to not know when your stock's earnings date is scheduled. Earningswhispers.com is an awesome free source of the data. put it into your Twitter feed, and they put out this lovely chart every weekend, and then each day they give you charts of the stocks that have earnings. And what about news? Well, I didn't even highlight the inflation expectations and the budget on Monday, but look at Tuesday. CPI, core year over year, core year over year, and then CPI without shelter. You don't expect this to be a market moving event. Look at what happened with PPI this week. Market's up 100 to 200, down 100 after the report comes out, made their way back to break even, and then ended the day down fairly hard. Wednesday, just when you think it's time to go outside and be free of the market, you got the Fed announcement at 2 p.m. and a Fed conference at 2:30. Thursday, we got jobless claims, and Fridays, we got some PMIs. It is a busy, busy week in the markets. So it was a downtrend week for the stock markets this week after a big run in a short amount of time. Entering the week, this quarter, the Dow was up almost 20%, the S&P 400 16.8, the 2000 13.7, the 500 13.6, and the NASDAQ 8.4. We started the week soft as concerns the Fed will over-tighten were fed by a hot PPI. Concerns of lower growth led to market losses. Economic news vary with a strong ISM non-manufacturing index, a beat to the upside on employment, but also we saw continued concerns on tech and other layoffs and cautious comments about the consumer from multiple CEOs. This week, as I showed you, big numbers, Fed announcement. So a Santa rally this week seems to be less certain, but so much depends on the data and announcement this week. I remain with cash on the side, small starter positions. Tuesday and Wednesday will move the markets. It's hard for me to go into any significant amount before that news is out. And it remains a risky market. So I think we go lower. However, news, a soft CPI and a less hawkish Fed could bring Santa back. So let's hope for a Santa rally so we can short stocks at a higher level. But I'm putting my money that we finish lower, at least in January, than we are right now. So maybe we see a short-term rally. So I like to start with my comments, then we go on to the charts. And, love to see more people at our meeting next year in Florida. And I'm going to try, as I told the folks at my meeting, to do a meeting come June or so in the West Coast in Orange County again, if there's interest. And then we will do another one in South Florida in the best time of year, which is December. So let's move forward into wealth charts. And we'll start with hot stocks. And you'll notice on the bullish search, the only one above a couple hundred is gold. And gold has started to move. The issue really remains gold in the 200. Silver's actually made a much bigger move. When I look at the indices, let's just start with the spider. This here is a downtrending resistance line that goes back. It's a pretty good trend line going back to the beginning of the year when the market rolled over. I think it's a pretty important trend line, to be honest. And we have failed at it at the top in April, in August, and again in December. Now, do we come back to the 50? That would be an expectation I have. Does the 50 hold, or do we revisit the June lows? I think this market is at risk of a significant pullback here. But if you want to hold on for hope, that 50 is trending up and could be short-term support. If we look at the rest of the market, you'll see we pull close to the 50 on the Qs. The leader of the market is the diamonds, and the diamonds remain above that the trend line, which has gone from resistance to support. The the IWM has pulled back to the 50, so they're at an important place to watch. The VIX has pulled back despite the market softness, and one of the drivers of the recent bull has to be the weakness in the dollar, which is now just bouncing daily on its 200-day moving average. Flipping to the commodities, weak dollar, you can see gold is strong, but it's got to get above that 200. Silver stronger, has broken out above the 200, and perhaps it's the industrial issues that are driving it. Oil and gas are weak, and we've already talked about interest rates. Now, one thing I like to look at is my weekly market timing model. So easy to create in wealth charts. It's a combination of weekly stock prices, a 30-week WMA moving average, and my Bongo single time frame, which is provided to all wealth charts users. The the marketplace version actually has 3 time frames. When I'm looking for a price above the WMA and a green Bongo. So the spiders are still in buy territory, but they're coming under some risk. The Qs are not in a buy. They're not in a sell because the weekly Bongo's green, but they're concerning, as is the IWM and the true leader of this market, which had a rough week, but is still well above the WMA, is the diamonds. Then I typically look at the market theme to get a sense of what's working. And when the market's heading up, it's large caps. When it's heading down here, it's small caps. You could see on the daily, it's favoring large caps, and so it is on the hourly. When the market's down here, it's value. So we're looking at large cap value, which to me sounds a lot like defensive plays. So now continuing on, I take to look at my scanners. We'll start with the bull scanner. Now, I have a lot of things in here. Let's start with the heat map. And the heat map shows you the market, the S&P 500 for Friday. And notice Tesla was up 3% and Netflix was up 3%. Meta was up a few pennies, but most of the S&P 500 were down. We saw the weakness in the S&P 500, and we're seeing some breakdown in leaders. Now, I do use other programs, and one program I use is HGSI, and I just wanted to talk about its industry group rotation. I like how I sort it here, but it's got a message here. So I go into market analysis folders, number 7, industry groups. It has the market divided into 174 industry groups. And if I go to a 2-day force, and this is how I like to look at things that are going up versus down. We were at about 80 2 weeks ago. We were at 60 last week. And on this Sunday, I have all of 9 industry groups that are positive force, positive momentum. I have, on a longer term frame, I've only got 8. And if I look at to the downside, I have 46. So that is a massive move with increased stocks and industry groups to the downside. So I always like to start with that. And if I look at this, this is a mixture: entertainment, marine shipping, internet, cable, home and office furnishings, tobacco, computer hardware, publishing, and real estate. So it's really a mixed bag. Notice what's not there. There's no energy there. Energy has really changed. So I like that as a tool to help me understand what is working in the market and what's not. But I like my scanners in wealth charts. So let's go look at Wealth Scanner to start with. Now, Wealth Scanner, I have it set up here to show me the strength in the market. And it's really the strength in a weak market. And no shocker, the main strength here is silver, which has broken out and still way off of its earlier in the year highs, but it's made a nice run off the lows. Now, when you find things with Wealth Scanner, they've usually moved already. And the higher the number, the better they've been performing. SOCL, we've been watching it for the last couple of weeks. It's still below 700, has not moved much. It's probably related to the strength in Facebook. And then you got things like muni bonds, then gold. So, and then the numbers start to drop. So I like to start there. Now, you could perhaps pull up my combo list of my top stocks for the week from a number of sources, and we'll give that a second. And what it's doing here is it's going to rank by strength the stocks in my combo list. And this will give me an idea of what stocks are the most strong in the market. So I actually have this stock because it's a China play. It's MLCO. It's a cheap stock. It didn't used to be so cheap. You could see it was up here was $24. Kill this so you can see the date better. And you could see up here earlier this year in March, it was 24. Actually, that was last year in March. So MLCO, but is it buyable here? I guess if you're really bullish and you look at how far it's come, but I'm looking for stocks that are breaking out. I don't know ASRT, but what a beautiful pattern. Cheap stock, and I'm not a cheap stock guy, but this stock has broken out. And notice it's got the green dots showing that it's got some bullish momentum, but notice most of them were showing you the stock back, 25, 30 cents ago as it was starting to break out. And notice the OBV and RS have already been running. Dada, that's what my granddaughter calls me, so I'm favorable to the name, but I don't know too much about this. This is certainly a stock that's bouncing off the bottom. VIPS, look at that 880 score. This is another Chinese stock, and this one looks really tasty. Again, it's had a big run, but look at the weekly breaking out a new EMS signal. So you can certainly put your list of stocks. You could put the NASDAQ 100 in here, and this is going to give you a sense of some of the good stocks in the market. But again, I'm looking for stocks as they're breaking out and not necessarily the big current leader. Netflix, which I mentioned before, had a big gap up on Friday, closed near the bottom of the gap, but it was a very powerful day, and it remains to be seen as Netflix starting its seasonality. Now, scanners allow you to fine tune and pick what you're looking for. And what I want to find are stocks that are coming off of their moving averages and breaking out. So a stock like AVGO, well, one way to look at this is it's already run a lot, and it has. When you look at the weekly, it's well off the highs, but it just broke out above its 200. It had volume, a breakout, momentum, OBV, and relative strength. So AVGO looks interesting. DocuSign, this is a beaten down COVID play, and what's interesting to me here is it did break above the 50-day moving average. It's got 3 green dots, a relative strength and OBV look good. Look at the massive volume. Domo is another stock that had some interesting things occur on Friday, taking out the 50. 2 big volume days in a row, breakout, momentum, value, relative strength and OBV. Most of these are stocks that are very beaten up. As I look at the list, Chewy also looked interesting. Now we dropped from 4 dots to 2 dots, but Chewy is already broken out, a new base. It's in a squeeze, starting to have green dots and volume. Is Chewy ready to break out? So one thing that I like to do is create a strong list of stocks. This is the weekend review. This includes my top-down analysis and my combo list. And then I'll add stocks to it as the week goes on, and I'm looking for stocks that look interesting. Now, it's also a really tough market, so one doesn't expect to find a lot of great setups to the long, but there are some. In fact, we'll come back to that. We can go to my bearish scanners and really do the same analysis if we look at the weekend short review and look to see where the action is. This one caught my eyes because I know this company extremely well. It is a drug distributor, and drug distributors have giant revenue, teeny-weeny margins, and they seem to only go up. And you could see how many stocks have I showed you. Let's just put this on a monthly chart. Have a pattern like this in the setting of the 22 bear market. Well, Tudu, Cardinal, and AmerisourceBergen are just like McKesson. But these things are extended, especially on the weekly, have had a major run, and they're breaking down. Now, these are leaders in the market, so you always got to be careful shorting leaders. But we broke through the 50. We had volume, momentum, and breakdown. We've got a breakdown of relative strength and OBV. You like shorting stocks that are closer to their highs than their lows, and this is one I'm going to look at. Now, this is also one where if I was to take a short position, I know that I could put my stop just above the 50. If I wanted to give it a lot of room, maybe the 17. But, it's got to be careful shorting leaders. But this stock looks like it's ready to break down. And See what else made this list here. Beam Therapeutics, don't know this one at all. And you could see it failed at its 50, and that's a nice whole failure pattern coming out of squeeze, weakness in relative strength in OBV. Does this come down to 38? It's certainly possible. Amazon. God, I'm so glad I don't own my Amazon anymore. But look at Amazon. Amazon is just not the same as it was. And look at the breakdown off the 200 back in August, and the stock just continues lower, failed at the 50, new lows. This thing looks like it's going lower as well. Now, a lot of people I talk to don't have a lot of interest in shorting the market. Their money's in an IRA. So they're looking for, Jeff, is there anything that I can do that I can look at market shorts, go up if the market goes down, but I can do it in my IRA? And the answer is probably yes. So let's go back to the bullish side so I don't mix myself up. And let's go into my watch list of contra ETFs. So the contra ETFs, they're an ETF, and the way they're designed is to go up the opposite of the instrument that it's matching. So first thing is mostly green on Friday, unlike the market, mostly green on the week, unlike the market, and a couple of really good returns on the market, even though the market's been strong over the past month. So DOG is a ETF that will go up when the Dow falls. Now, when we looked at the Dow, we talked about stock hadn't broken down yet on the diamonds, but the rest of the markets have. Now, what happens to this instrument if the market continues to roll over? It will go higher, and it'll have to contend with resistance. But you want to see a bullish chart, it's above the 17. It just came out of a squeeze with momentum and a breakout. Relative strength and OBV are strong. That's the dog. Contra Dow, it goes up when the Dow goes down. How about SDS? This is contra the S&P 500. S&P 500 goes down, this will go up in a relatively 1-to-1 ratio. And you could see, not a great chart, but we're mostly buying this as protection or because we think the market's rolling over. It's not an investment, but it looks like it's going higher. It too has some resistance right above. If you want a hypercharge, you can get the SPXS, which will be 3 times the movement of the S&P. If you want to go after the Qs, you can short the QQQ, or you could buy long an ETF called SQQQ, and this will go up as the Q falls. And then if you want to short small caps, there's always the TCA, which will go up when small caps go down. So essentially, TNA is a long ETF mimicking small caps with a 3-to-1 leverage. You could buy TNA when the small caps are going up, but if I said TZA, I apologize. So TNA goes up when the small caps go up. So if you think small caps are going down, you could short small caps, or you could go long TZA. And TZA, if you look at it here, I don't think the daily change there is correct. You could see TZA had a pretty strong day on Friday. So I did find stocks that were interesting to buy or short. I'm not really too interested in jumping in the market either way right now. And is this the list? Yeah, it's a pretty big list. Now, one thing I'm going to point out, there's a lot of Chinese stocks in here. I think Domo is probably Chinese. YY is another Chinese play. Now, it's broken out. It's perhaps starting to run away from me. And then I look at the weekly and I go, well, it's way down in the pattern. That looks very interesting from a technical perspective, breaking above the 200 on massive volume. VIPs we already looked at. So these are Chinese stocks. Sting is we've talked about this one many a times this year. It's a great mover in the marine transporting energy. Sitting above the 17 in a squeeze. It's one that's on my watch list to watch. I talked about MLCO. And these are just some of the interesting Chinese stocks. Billy is another one that's broken out as well. I'm not sure if that's a Chinese stock or not. And a lot of people are talking about marijuana, and will the lame duck Congress, with the House still controlled by the Dems, try and pass some marijuana legislation before they're done? Well, if you look at the marijuana stocks like Tilray, these have not been great performers. And in fact, they ran up and then they just died. But what has been a great performer is VICI, which is, as I understand it, is a REIT where you can grow marijuana, and where a lot of the commercial entities have their whatever the grow houses are. So here's a way with a dividend that one can play a potential marijuana story. So there are things out there that look okay. And then to the short side, there are a lot of things that are very compelling to look to the downside. Now, a lot of these just go into a list to kind of give me a sense of what the market's doing. Apple, I think, is a very, very interesting point here. Why? Because Apple failed at its 50. And when a stock fails at the 50, it's an ice-hole failure. So it wouldn't shock me to see Apple come down about $10 from here. What would that do to the NASDAQ? Amgen's been a major leader, and despite one of its competitors having negative news on Friday on their drug, it's breaking down. Now it's right off of all-time highs, and shorting all-time highs is probably a secret sauce for getting hurt in the market. But if Amgen rolls over, what does that say about the rest of biotech? Some of the stocks that I've been really loving of late have been the large healthcare insurers. But again, you don't got to be careful shorting all-time highs. But Elevance looks like it's got a failure off of a lower high. And is it going to come down and test? Maybe. And not only Elevance, but Humana, probably going to come down to the 50. We'll see if it holds. And then if these are bad, there's going to be another one. And let me see if I can remember which one it was. Maybe I didn't pick any of the other payers. I thought there was one other one that looked weak as well. Here's that McKesson breaking down, one that we looked at earlier. So I see a lot of mixed bag in this market. I think the reason why I would not be shorting a lot right now, and the reason I'd be careful going very long right now, is the exact same reason. And that reason is we got a CPI on Tuesday and we got Fed speak on Wednesday. So to me, it's a little bit like the horses. So on that note, I hope you have an awesome week. We'll probably be posting some midweek on stocksanddocs.com, and trade safe and cash as a position.